Big tech has taken a hit this year, with shares of Meta, Alphabet, and Amazon all down over 40% year to date. But our next guest is turning it tactically constructive for the year to come. Evercore ISI Senior Managing Director Mark Mahaney joins us now. Mark, always great to get some time with you. Before we get into some of your picks and thinking on the space, as someone that has been covering tech for as long as you have, what has this year been like for you? Some of these declines, many investors have never even seen before.
Well, this is that's right. If you started investing after 2008, this would have been the worst year you'd ever seen. So that's the last year in which you had consumer tech trade off as aggressively as it did in 2022. I mean, there was a series of factors that are all well known now: aggressively rising interest rates, inflation, softening economy, foreign exchange working against kind of the major multinationals. Maybe a little bit of regulatory risk in there. So there was just this really nasty cocktail of factors that came together that really undermined tech growth stocks in 22. I think some of those factors have changed, and certainly it's reflected, I think, in where estimates are and where multiples are. That's why we're more constructive, but we're tactically constructive. I don't want to be too nuanced about it, but we need to be, because softening demand trends are going to mean decelerating revenue growth and pressure on margins for the next couple of quarters. So that makes it very hard for stocks to outperform. You have to be very selective to find winners in that.
Can tech rebound without a Fed pivot or at least a pause?
I'm pausing on your pause question. So I guess the answer is no, it can't. But it's the magnitude of the move, and so going from 0 to expectations of 4% plus, 4 to 5%, like that's a massive move. And going from here going forwards, I just don't think the interest rate shock is going to be as great as what we had this last year. So that's sort of the answer to your question. I think if rates keep rising and the Fed remains hawkish, it's going to be very hard for growth tech stocks to materially outperform. I don't think they would underperform in the way they did this year. So maybe that's the right answer to your question, Brad.
Mark, are some of these tech stocks, these big cap tech names, second half 2023 plays? Because you would have to think comparisons year over year, sales earnings will be much improved, and we might finally get that reacceleration in growth rates.
Well, that's the hope that's in the market. And so and that's kind of how we're framing some of these names, like especially Amazon and Google that we look at. I think Facebook, the story, the setup on the stock is a little more interesting for the first half of the year, just because, look, you need to, we've got softening demand trends across the board. What you need are companies that are taking cost actions. They got to tighten the belt like all households do. When revenue trends weaken or income trends weaken, you tighten the belt on costs. Facebook did that with a 13% RIF. Amazon and Google haven't done that, especially Google hasn't done that at all. So that's going to cause problems for them in terms of they're going to see more margin pressure than I think is in street estimates. You got downside risk there. Amazon's also going to have some issues. I think they probably need to get a little bit more aggressive on costs. So yeah, I think for the mega cap names, it's going to be tough. Those aren't in my top picks, except for Facebook. The real top picks for me going into this next year for a variety of reasons are Netflix and Uber.
You mentioned Amazon, Mark, real quick on that name as well. Tough year for them, notably. How much time do you think Andy Jassy has here to get things correct?
Oh, I think he's going to have a fair amount of time. So what we all need to ask ourselves is: are the challenges these companies facing, are the challenges that Amazon's facing, are they structural or are they cyclical? And, structural, is there something really fundamentally changed about online retail? No. Cloud computing? No. Or the new competitive dynamics? No, I don't think so. Those are all highly competitive spaces. But the advantage that Amazon has is that it's the leading online retailer. And I think at the margin, they're gaining share. Cloud computing, I think they're maintaining share. They still got this great product mix shift or revenue mix shift towards higher margin, faster growth businesses, advertising and cloud computing away from retail. So I think the core thesis on Amazon is well intact. It's just that it's fully exposed to all of the consumer softening spend, especially in consumer discretionary items, and then inflationary pressures. And the one that's really going to persist from earlier this year are the higher wage costs, and they're going to have to scale against that. So it's going to take time for the Amazon ship to kind of right itself, but it will right itself. And I think depending on how long term your time horizon is, if you're willing to look out more than a year, I think Amazon's a good price point right here. I think it's at a 5-year trough multiple. But if you want to perfectly time it, which is probably not a good thing to do, but if you're trying to do that, maybe you're waiting until a little bit later in 23 to do that.
And so with that timeline, does high growth internet still have the same type of teeth as it did over the past several years in leading the bull market that we had just come out of?
You're asking a really good, thoughtful question. It's the billions and billions of dollar question. I think some of these names do. I don't think anything's really fundamentally changed about Amazon. Again, is there something structural or is it something cyclical? There are some structural issues, however, with Google and Facebook. I mean, there is the rise of TikTok. Now, there's an open question about what's going to happen to TikTok and whether it as an asset or as an app continues to exist in the U.S. within the next 5 years. That's an open question. That wasn't an open question 6 months ago. It is now. So maybe that risk is somewhat hedged, but there's greater regulatory issues and then these Apple privacy changes. So there have been some structural challenges thrown down to Google and Facebook. Google probably is able to better overcome them than Meta will or Facebook will, but I bet you Meta does too. And what I find so interesting about Meta just as a stock is the risk reward here just seems highly asymmetric. The stock's trading at around 12 times GAAP earnings for an asset that I think is going to recover to 20% growth. That's already high margin business, 30% plus GAAP operating margins, generates a lot of free cash flow. I just think you're going to have a major re-rating in Facebook or Meta stock. I don't think it's the next Yahoo. So that's kind of why, hope I said that right. I think that's why it's one of our top picks.
We usually add a few more O's on and kind of a little bit more inflection with the voice, but that's okay. We'll let it slide for today, Mark. I did circle two words within your notes, and it was healthy bifurcation. So perhaps you could take us into like a little Yahoo U on that, if you will. Just this concept of healthy bifurcation and how you see it from your lens.
Well, look, in the first half of 22, all tech stocks, or at least all internet stocks, traded off the same. It was about 50% year over year. 50% decline in the first half of 22, regardless of whether you're big cap or small cap, high quality asset or low quality asset. There was no bifurcation. There was no opportunity really for stock pickers. In the back half of the year, you've had some pretty massive outperformers: Netflix, Etsy, Uber, Pinterest. Now, for a couple of different reasons, whether there was activist involvement or cost steps being taken, or in the case of Netflix, there's this new advertising-supported streaming service coming out. Uber reached free cash flow inflection for the first time ever, and then did it again. They had positive free cash flow for 2 quarters in a row. So there were company-specific factors that caused those stocks to outperform. That, to me, is quality bifurcation. That tells you it's stock pickers' time. That's a good thing. That's a good setup for 23. So you're looking for names that are somewhat recession resilient. I don't cover defensive stocks, so somewhat recession resilient is about the best you can get. That maybe have a new product line and have already taken cost cuts. And I think Netflix kind of fits this bill so well. Recession resilient, you were just talking about Six Flags before. You want inexpensive entertainment? How about $6.99 for 1 month of Netflix? By the way, both of your prior commentators, I think $6.99 is about the cost of a grande latte or something like that with sprinkles. You can get the whole month of Netflix for that. So that should be somewhat recession resilient. It is a new product line. I think they're expanding their value proposition. More people are going to sign up for Netflix because you've got broader range of price points, including cheaper ones. And then finally, they did take cost cuts earlier in the year, and they didn't as aggressively overinvest post-COVID. That's why I think Netflix is so interesting here. And this is the first year, 22 was the first year you could ever buy Netflix on a GAAP PE basis that was somewhat close to the market, so market multiple. So that's why I find the setup on Netflix so interesting.
Mark, I do have to correct you there. Our producer's order, I think, is pushing about $10. They get extra caramel and sprinkles, but that's just our case. We have a very thirsty team here in the morning. I will follow up, though, on Netflix. Are investors just too pessimistic? Is now the time to be aggressively buying this name into next year ahead of what looks to be several positive catalysts?
Well, I think so. I mean, it's our top pick. So what could go wrong? So look, I'm a big bull on Netflix. I upgraded this a couple of months ago. I downgraded at the beginning of the year. No, I didn't call the top. No, I didn't call the bottom, but I'm trying to catch the meat of the moves. And I just want to step back. Like what we've known out of Netflix, having covered this company for, almost 2 decades, or even longer, and then watching rising price sensitivity, like their price actions, taking that a 30% reduction in their basic Netflix subscription price. That addressed a real issue. There was rising price sensitivity amongst Netflix subs. And then the math on this is they can actually cut their price by 30% and generate more revenue per user. You rarely see that in business history. I mean, I've yet to find another example. I'm sure it exists somewhere, but this is it's a very rare opportunity when you see a business be able to do this. And I know the stories have come out about how they had to give some of the cash back to advertisers because they couldn't meet all the demand. Stop. That's a really positive thing. They've got so much advertiser demand that they couldn't fulfill it. So the advertisers are there now as they start marketing the service. And by the way, if their core users just stick with the current plans because they're happy with that and keep growing off that, that's a good thing too. So there's so many wins here for Netflix, and I think it's a very good management team. They were probably too late in rolling out the ad-supported business, but that's the past. Going forwards, this service is up, it's running, and then they're also going to be cracking down a little bit on password sharing. I think a lot of us could probably know somebody, have a friend of a friend who kind of shares the Netflix account, and so there can be opportunities to slightly increase monetization. I think there are catalysts. I think valuation is reasonable. We've had a big run in the stock. I grant you that. But I think estimates will go up, and I think the current multiple on the stock can hold, and you can make money that way. It's our number one pick.
Well said. Evercore ISI Senior Managing Director Mark Mahaney, always good to see you. Thanks for coming on all year. We'll talk to you next year.
Happy New Year.
Appreciate it.